let's start talking about certain metrics that have been traditionally used to measure whether or not a real estate property is going to be a good deal. You need to understand your numbers. You need to understand the matrix. Real estate isn't just about buying property. It's about building long-term wealth. And here are some key numbers every investor should understand. I'm going to share with you some traditional things on the market, and then I will give you my personal 2 cents based on my experience. Okay? The first guideline that I'm going to give you is a guideline that was popularized by Bigger Pockets almost a decade ago, or maybe longer than that, right? So the 1% rule, this is a guideline. It's a guideline, it's not a guarantee. And now that I have invested in places like Oklahoma and Colorado, two completely different markets, I can tell you this rule may have worked in the 1960s, in the 1970s, even in the early 2000s. But let me tell you something, in the year of our Lord 2025, it is very difficult. And it's not the only way to assess whether or not a property has value. But before I go into my tangent, let's talk about what the 1% rule is first. So the 1% rule suggests that the monthly rent should be equal to 1% of your purchasing price. If you buy a property for $150,000, your rent that you should get for that property should be $1,500. Now you see why I'm like, I don't know about that. This rule worked well in the year around before the year 2018, okay? However, with high market growth, like in California, this is highly unrealistic. In smaller markets, like let's think Arkansas, even where I currently am in the Oklahoma, Texas region, this is also very quickly becoming unrealistic because even in these areas, the prices have gone up. Let's say you go to some podunk little town in Oklahoma. Depending on where you buy that property, you might never get $1,500 for rent. And let me also be very honest with you. The odds of you buying a property for $150,000 that you would rent for $1,500 without putting any extra cash in is very low. Even in Oklahoma, honey, let me tell you, especially today with these high interest rates. Okay? And also, I want you to understand a few things. Those lower markets where you may meet the 1% rule will also have slower appreciation. Remember how in real estate we get paid multiple ways, with appreciation being one of the main things people like myself are shooting for. I shoot for appreciation, I shoot for principal pay down, my renters paying my mortgage, and I shoot for tax benefit. The rental income is great, but it's not really what I focus on. So when you opt for the 1% rule, know that today it's very difficult. It's not impossible. It's just very difficult. You often find these deals in smaller markets that tend to have lower property values, but those markets will also have lower appreciation. Now let's talk about the second metric, that is cash on cash return. This metric will measure your annual cash flow relative to your cash investment. Remember how when I was talking about, if you buy that property for $150,000, you will have to put a lot of cash in order to get that $1,500. This is why that cash on cash return value really matters. So the formula here is your annual cash flow divided by the cash invested equals your percent return. So for example, if you invest $20,000 and you earn $4,000 per year, your cash on cash return will be 20% return. You would take your annual cash flow, which is $4,000 a year, and this is really important. By cash flow, we don't mean the rent money that came in. We mean I paid off my mortgage, I paid off the handyman, I paid off everything. What is left over? is what I divide against what I invested. Yes, when you begin to add up these numbers, you begin to see how, real estate investing numbers are rough. Some people are getting about $150 a month in cash flow. If you're only getting $150 a month in cash flow, at the end of the year, honey, that's $1,500. If you invested $50,000 and you're only getting $1,500, your cash on cash return, right? You do the math. 20% cash on cash return, you need to determine what is a good cash on cash return for you. For me, as a woman who's invested in multiple states, from Oklahoma to Colorado to Texas, I tried investing in California and I was like, nope, let my people go. This is not for me. Okay? Maybe if I had a husband and like multiple sources of income, like with the husband, I probably could have done California, but I was like, California, let my people go. It's not for me. In Colorado, I would have happily taken a 5 to 10% cash on cash return because the appreciation is bangers. Here in Oklahoma, I do like a cash on cash return of above 10%, 10 to maybe 15%. But like with anything, it's very situation dependent and you look at it holistically. Other key metrics that I want you to be thinking about is rent to price ratio. Do a quick screening. What's the price of the home and how much can you rent it for? You need to compare the cost of buying versus the cost of renting. This to me is a big number that I look at, right? And by cost of buying, I like to look at how much I am paying for my PT mortgage, principal, interest, taxes, and insurance. I look at that number. Let's say my mortgage is $3,300, right? Are there any other expenses associated with that? I like to add 20% to that. So let's say if my mortgage PT is $1,000, I add $200 for buffer. I do like to rent it for about $1,200. If I can get $1,200 for me, I'm good. Even if I don't make any cash flow, the fact that those key things are covered, Nandy is a happy woman because I am not using real estate to fund my lifestyle. I'm using real estate to fund my retirement. That is my strategy. Other key metrics, especially for people, let's say you don't have a 9 to 5 job like me. You will be doing some sort of hard money loan and then you will refinance into a DSCR. If you don't know what a DSCR loan is, a debt service coverage ratio, I will put a link here into the financing video so you can go take a look at that. This is where you show if your income covers your loan payment plus about 20% above that. So when you have a DSCR, they tend to require for you to have about 120%, whatever the PT mortgage is, right? So just like I said, the mortgage is $1,000 for principal, interest, taxes, and insurance, right? Have a 20% buffer in case of emergency. You can actually get your property funded without them looking at your income. Let's talk about the 4 ways you win in real estate. I just shared with you a lot of metrics, a lot of guidelines on how to assess the market, how to find the right deals. But these metrics do not stand alone. There are many different ways, honey, you can win in real estate. Buying a rental property gives you multiple streams of financial gains. The first one that almost everybody looks at is cash flow. This is the monthly profit after all of the expenses have been paid. For me, this number is important, but it's not that important. For some people, it's really, really important. I'm going to be sharing all of these ways of winning in real estate with you so that you can map out your strategy based on what's most important to you. The second ways of winning is appreciation. Your property value will rise over time. If you are somebody who values appreciation, then from the get-go, buy with appreciation in mind. Of course, We understand that we cannot predict where property values would go. It's so funny. When I first started in real estate, I would always get pissed off because there will be a lot of smarty pants who would tell you, well, you can't predict appreciation. But for the most part, we're talking thousands of years of history that has shown that real estate will almost always appreciate depending on the right market. This is why the beginning of this conversation, we talked about understanding your market. Knowing everything that I know, I just recently bought into a less than ideal market. And let me tell you something, your market matters. When you buy in the right market, that appreciation is chef's kiss. I buy for long term appreciation. I buy for retirement. So for somebody like me, a market where my properties would appreciate, where my rent prices will continue to go up, even if today, let's say I'm underwater on a property, I know that in about 30 years, that property will be paid for in full. 60% or so of the rent that has gone up from when I bought it 30 years ago will be going to fund my retirement. The third benefit is tax benefits. This one, it was not really something that I had in mind, but honey, let me tell you, the tax perks when you have rental properties, double chef's kiss. You can write off depreciation, interest rate, repairs, right? All of these will reduce your taxable income. And I'm going to try to have a video specifically on the impact having rental properties on your taxable income if you have a W-2 job. The fourth way you win in real estate is with principal pay down. Your tenants will pay off your mortgage. So you are building equity. With appreciation, you are building equity, but then you're also building equity with principal pay down. So it's a two-pronged approach. When you have rental properties, you're building equity with both principal pay down and appreciation. That, honey, is the superpower of real estate. This is why very early on, I wanted to start my investment journey with real estate. And I'm so glad I started 7 years ago because today it is a lot harder. Not impossible, it's just a little bit harder. In 2017, I bought a property with 3.5% down payment, an interest rate of 3.5%, and the property I bought for less than $180,000. Today, that same property is worth almost $400,000, and you cannot buy it with interest rate less than 6.5%. All right, so it's harder today. Now, let me tell you something though. Despite it being hard, it's still one of the best investments that you can ever make. You just need to find your strategy. So, this is a series. One of my videos here in about a week or two is going to be about specifically how to select the right real estate investment strategy. Before we close out this video, I want to talk to you about two very important things. Please bear with me. Let's start about red flags to watch for when evaluating real estate properties. Not every cheap house is a deal. This is really, really critical. You need to avoid surprises by checking for the big five. You want to understand critical components like foundations, cracks, uneven doors that stick. This will be a costly fix for you. We're looking at anywhere from $5,000 to $30,000. You need to look at plumbing. Look for leaks, water stain. This could cost you anywhere from $2,000 to $15,000. Electrical. Do they have any outdated wiring? Because this could be a fire hazard, and rewiring a home could cost you upwards of $20,000. Oh, honey, I have been there. You need to look at the roof, missing shingle, any leaks, because in your roof, you're looking at upwards of 15,000, if not more. The last thing I want you to check is HVAC. You need to check the system's age. You need to check that it's functioning. And let me tell you this, when they conduct that inspection, you better be present. You better be looking. The biggest mistake I've made in my career as a real estate investor is not attending my inspections. Never again would I buy a house without being there when the inspection is happening and looking at everything, because that is how you get a little bit of money back in your pocket, and that's how you make sure that you do not have any surprises. So now let's talk risk management and exit strategy. Every investor should plan for what ifs. I'm telling you, I am somebody who, when I was investing with scarcity. I was investing in a hurry, right? I would see the opportunity to buy a house and I would just jump all in. And this almost always left me depleted. You can follow my debt pay down journey here so you can see how me taking on that approach left me completely depleted. Now, no regrets. I love my journey. I love where I have been. But I want you to have an emergency fund. You need to keep reserves of at least 3 to 6 months of expenses for repairs and vacancy. Now, for somebody like me who's a high income earner, I was able to withstand not having a lot of these reserves because my income compensated for that. But I'm definitely changing that. That is why in the next year or two, I am not investing in real estate. I'm actually renting and saving money so that I can build up my personal emergency fund, my business emergency fund, and my real estate emergency fund. And also, interest rates are so high. When I broke down all of the numbers, you guys, it was significantly cheaper to rent than it was to buy. That's another video, right? I always thought it was the other way around. I've always been, I'm never going to rent, I'm going to buy type of girl. Nope. Better to rent than to buy in 2025 in Oklahoma. Your exit strategy. Can you resell the property quickly if needed? Is it in a desirable area with solid resale demand? Let me tell you, as somebody who bought out of emotion a property that I really like, honey, this is important. But the reality is, as an investor, it's just part of our growing up initiation. The other thing I want you to think about for risk management is insurance. Right? You need to consider having some sort of landlord insurance or possibly an umbrella policy for added liability protection. Because let me tell you something, we're in America. America is a litigious nation. You do not know who will come after you. Here are my closing thoughts. Finding the right deal will take patience, it will take data, and it will take discipline. You need to stick to the numbers. You need to evaluate that market carefully. And always, please always do your due diligence, because with real estate, those rewards are high, but so are the risks. Remember, rental income is not the only way to win in real estate. So when you are determining what a good deal is, make it comprehensive. Assess everything, the rental income, the potential appreciation, the tax benefits, and most importantly, the principal paydown. All of this work together to build long-term wealth. Before you go, follow me on my other platforms. On my business channel for career, business, and money strategies to build your corporate exit strategy. On my lifestyle and travel vlog for the real life behind the strategy. And on my podcast, From Corporate to CEO, for daily side business tips and motivation. But the real work happens in the community. This is where we support each other and build this together. Same values, same season, and same direction. I'll see you there.